Hello, hi, evening everyone. All right, so just let me give a moment to share my slide. Okay, so thank you for joining our webinar session for today. Right, so first thing first, I need to share a disclaimer to all of you. So what we're about to share tonight is for sharing purpose knowledge only. It does not constitute any financial advice, any trading or any investment advice. As you may aware, trading or even investment carries their own risks. So you're advised to do your own proper research before doing any buying or selling of the product. All right, so before we start, a little background about Philip Capital Sdn Bhd. We incorporated on 7 October 1995, a wholly owned subsidiaries of Philip Capital Holdings Sdn Bhd, formerly known as Philip Futures Sdn Bhd. We are a trading participant of Bursa Malaysia Derivative Berhad and a participating organisation of Bursa Malaysia Security Berhad. We are also a holder of the Capital Market Service License or CMSL. Alright, so our headquarters is actually in Kuala Lumpur, but we have 11 Philip Investor Centre across Malaysia. We also won number one top choice broker award, the champion for best retail derivative trading participant, and a runner-up for best overall derivative trading participant. So, for the Bursa Excellence Award 2024. So we also have our branches outside of Malaysia, not only in Malaysia, we also have in Singapore, in China, Japan, Thailand, Indonesia, India, United States, and also the United Kingdom. And we also offer not only local exchanges, we also offer foreign exchanges such as from the US, from the UK, European, Hong Kong, Japan, Singapore, and Australia as well. So why Philip is your one-stop solution for your trading? Okay, because we offer three main products which are futures, equity or stocks, and contract for difference. All three products we offer both local and foreign product as well. So why Philip is your broker of choice? Okay, number one, we are award-winning multi-asset broker. We also offer 24 hours broking and execution support. We also provide advisory services, provide with our client the latest market news. We offer a wide array of products, and best of all, we don't have any platform fees because all of the platform that we offer to our client is from Philip itself. So if you open an account with us, you also can request for free one-to-one coaching. If you guys just starting or don't know where to start, you request for maybe an introduction to the product itself, or maybe a platform coaching if you guys are not familiar with the platform that we are offering, or also the charting system that we offer to our client. Okay, so we also offer weekly market calls. We offer market views and updates every Monday, 11 a.m. and also live counter technical analysis every Monday at p.m. So if you guys are interested to join our upcoming seminar and webinar, you guys can scan the QR code or visit our website. We also post there and we update regularly on our website. Okay, so if you guys want to open account with us, now it's much more easier because we offer online account opening. So you guys just need to scan the QR code and fill up the details to phone or maybe laptop, and you guys can open account through there lah. But if you guys are still debating on whether want to open or not, you guys can take a picture first also can. Okay, all right. So next, now the trading platform that we offer to our clients. So the first platform is actually Nova. Right. At first Nova was only for futures, but now we have upgraded the Nova. Now they can cater for futures, CFD, and now also US stocks. And if you guys are familiar with TradingView, the charting that powered Nova is actually from TradingView. So if all of you, if you guys have a TradingView account, you can link with your Nova and you can actually execute order directly from TradingView itself. But just a bit of disclaimer, just because you open account with Nova with us doesn't mean you have a free TradingView account. You still need to subscribe TradingView because you still need to subscribe their platform lah. Okay, so our second platform is Poems. This one is mainly for stocks lah. So they offer all-in-one watch list. Means in the platform will show the Malaysian market, the US market, Singapore market, Hong Kong market, and Australian market. And what best about this platform is they offer also the top 30 mover for each exchange. So mean you got the top volume, top gainer, top loser for all of the exchange. Means for US, Nasdaq, MX, New York Stock Exchange. So they offer all 30 top 30 movers. Okay, so we also offer sorry, so now still our ongoing promotion is invest US share or ETF from only 0.02% or minimum of USD 3.99. So now I will give a brief explanation about our current and our running promotion right now. So first, if you open account, you can get a touch and go reward. Means now the welcome reward is for 20 ringgit for one account. Means if you open securities, futures and CFD account, you are entitled up to 60 ringgit touch and go. Then if you finding 5,000 within a week after the account have been open, right? So you get extra 80 ringgit. And we also give trading incentive to new account opening. For securities, we offer CDS waiver plus RM100 touch and go. But you guys need to at least have 3 trades within 1 month. For futures, we also have free commission up to 5 lots for 1 month validity. Sorry. So our next promotion is right market swing with volatility index. So right now you can trade CBOE VIX or VXM from only USD $3. We also offer free market data for both VIX and VSM. This promotion is until 30 September 2026. You guys can also scan the QR code to get more information or visit our website. Okay, the next promotion is Mini KLCI Futures Special Promotion. So you guys can trade Mini FKLI at just 2 RM 2 ringgit 99 cents per lot. And also, Bursa also have a retail trading challenge. The top 15 most traded account will receive a cash prize up to 8,888 ringgit. This promotion is until 31st of July 2026. And our next promotion is grow your portfolio with CME Micro Futures. RM100 or free RM100 reward if you guys open account and subscribe the CME exchange. Okay, first trade buffer up to 100 ringgit. And you guys can earn up to RM280 every month. So this means if you trade more, you will earn cashback more for this ongoing campaign. The campaign is until 31st of July 2026. Okay, next is our SGX Asian Index Futures. Trade Singapore, China, Taiwan, Japan, Vietnam, and Indonesia Index for only 1.88 US dollar. This one is until 30 June 2026. So our next promotion is Trade Malaysia and US CFD. RM100 welcome bonus. You guys can earn a cashback up to 1,500. Commission at just 0.35% and interest rate at 5.50%. This promotion is until 15 June 2026. Okay, so now let's go to our main agenda for tonight. So let me introduce to the first speaker is Prane Yadev. Brings deep expertise in global macro, focusing on agriculture, metals, oil, rates, FX, and digital asset. His top-down approach research methodology enables him to identify key global macroeconomic trends across different asset classes. Combining macro trends with bottom-up commodity-centric fundamental factors help him produce comprehensive and sound actionable research. So for our second speaker, we have Umang Agrawal. He's a research analyst and finance. He's specializing in iron ore and dry bulk freight coverage. His research hinged on deep analysis of economic trends and policy development in China. He holds a master's degree in finance and investment from University of Nottingham, UK, and a bachelor in commerce honours from Sri Ram College of Commerce, India. So without further ado, Let's welcome the speaker.
Hi, a very good evening, everyone. My name is Omang, and today, thank you for joining us for a comprehensive discussion on iron ore. The idea behind this webinar is pretty simple. Iron ore is one of the world's most important commodities, yet, for many people, it still feels quite opaque and complex. So, over the next 40 to 45 minutes, we break down the market down one by one. Next slide, please. Before we deep dive into iron ore markets, a quick introduction about us. We are a Singapore based boutique consulting and research firm. We deal with a broad range of market participants and clients, including exchanges, hedge funds, family offices, and commodity traders. One thing that defines our work is the way we do and try to combine multiple approaches together. We don't just look at charts or quant data or macro analysis. We try to blend all of these to form risk managed trading strategies and setups. And this is very important, particularly in commodities, because markets rarely move because of one single factor. Next slide, please. Like I just mentioned, one thing we try to emphasize upon is that research is at the heart of everything that we do. We publish regularly on two primary platforms, namely Smart Karma and TradingView. We have also attached QR codes on the left and the right hand side of the screen. So whoever is interested in following our work more closely can scan these QR codes later at their own convenience. Okay, before we proceed ahead, I really want to spend a few minutes on the disclaimer because this honestly cannot be stressed enough. Everything that we discuss today is purely for education purposes. Nothing in this webinar should be construed as investment advice, trading advice, or recommendation to buy or sell any product. The examples, the strategies that we discuss today later in the upcoming slides are purely hypothetical and back-tested. Markets do evolve constantly. Just because something has worked in the past does not mean it will continue to work going forward. Please also remember that commodities are highly volatile. I know prices can move because of a multitude of factors, including policy changes, geographic disruptions, geopolitics, and macro developments. So, if anybody here intends to trade or invest in this particular market, due diligence and risk management are very essential. So here's the basic roadmap for today. We'll start with an introduction to the iron ore market itself, where does it sit in the supply chain, and then we'll move into supply and demand dynamics, including port side inventories, China's macro influence, and how our institutions positioning around iron ore. And then we'll touch upon technical analysis, seasonality, and finally a few back-tested strategies and their setups. So now the basic question is, where does iron ore sit in the supply chain? Can we trade it like crude oil, gold, palm oil, and rubber? Let's not talk about where iron ore actually is. Iron ore is processed and eventually converted into steel, pig iron first and then steel. And this next point is extremely important. Roughly 98% of all iron ore globally ends up being used for steel making. That means whenever we try to analyze iron ore, we're effectively analyzing the health of the global industrial activity. Steel touches up almost every major sector of the economy. Number one, construction. So construction uses steel for buildings, bridges, and real estate. Number two, household appliances. Here, steel is used in refrigerators, washing machines, and kitchen equipment. Number three, transport. Here, steel is used in cars, ships, railways, and heavy machinery. Last but not the least, energy infrastructure. Here, steel is primarily used in pipelines, transmission powers, wind turbines, and industrial plants. Now, all of these things naturally boil us down to China. China is by far the world's largest consumer of iron ore. In fact, China dominates global steel production and therefore dominates global demand for steel as well. And we will deep dive into this in the upcoming slides. Sometimes a policy signal from Beijing or China can move iron ore prices more than developments in the mining segment itself. Now, this particular slide highlights how Singapore Exchange or SGX iron ore market has evolved into a truly global benchmark. One of the biggest changes that we have seen over the last couple of years has been the financialization of iron ore trading. Now, what does this term actually mean? It means iron ore is no longer traded only by physical steel mills or mining companies. Increasingly, institutional investors, hedge funds, asset managers, proprietary funds are participating as well, and our growth has been very consistent. The chart that you can see on your right interest is very interesting because it shows how participation from Europe and the US has steadily increased over the last few years. And that matters because greater geographic diversification means better price discovery and market efficiency. And that is one of the main reasons why SGX iron ore futures are increasingly viewed as the global pricing benchmark. Now, let's simplify how the futures contract, the SGX iron ore futures contract that I just mentioned, how does that actually work? Each futures contract basically represents 100 metric tons of iron ore. So when prices move by $1 per ton, for example, the value of one futures contract will move by $100. Let's take an example here to understand this better. So let's say we enter a long futures position at $97.63 per ton, and later the same position is exited at 101.33 ton. That means your profit is $3.7 per ton. Because one futures contract represents 100 tons, your total profit is nothing but 3.7 multiplied by 100, and this gives you $370 per lot. This is essentially how P&L calculations in this market work. Now, this particular site also compares XGX IODEX futures and options. The futures contract is very straightforward. Each contract, like I just mentioned, represents 100 metric tons of iron ore, and contracts are available across all calendar months, starting from January to December. One important thing to note here is settlement. Iron ore futures provided by the Singapore Exchange are cash settled. That means there is no physical delivery of iron ore taking place at expiry. Instead, profits and losses, whatever the case may be, are settled in cash based on the final settlement price of the contract. Options, on the other hand, like we know, give participants the right but not the obligation to enter into futures positions. And options are also available on these futures. What's important here is how settlement works for options. Let's say, let's consider one scenario here that options have expired in the money. Now, in this particular case, the option is automatically exercised into the corresponding futures contract, and that contract is then cash settled using the final settlement price. Now, one more important thing that I would like to throw light upon on this slide is open interest. Open interest, like we all know, is essentially the number of outstanding contracts in the market. And that's notable because we did see increasing participation in the month of March. Futures OI increased by almost 20% year on year, whereas options OI surged more than 60%. And this shows how iron ore derivatives are gaining more traction month on month. Okay, having discussed the basics of iron ore and the contracts and where you can actually trade it, let's now discuss what are the key determinants in terms of supply and demand driving the iron ore market. And broadly speaking, the markets are influenced by three factors. Number one, global supply. Number two, Chinese steel demand. And number three, market expectations. On the supply side, Australia dominates global iron ore exports. It accounts for roughly half of the world's total exports, and importantly, around 80% of Australian exports are directed towards China. Second, Brazil is the second largest supplier of iron ore. So immediately we can now see how interconnected this Australia, Brazil, China trade triangle really is. One more important point, India and Russia are also among the top suppliers of iron ore. But India and Russia use the iron ore for their own steel making, domestic steel making. That is why their exports do not move markets in a larger fashion. And on a demand side, the chart towards your right does show that China dominates the entire market. China alone accounts for 73% of global iron ore imports. So whenever Chinese steel demand changes, the impact on the prices is usually very fast. Like we just discussed that China is dominant in terms of iron ore imports. China has also been producing more than 1 billion tons of iron ore crude steel annually between 2020 and 2024. Now, this is a very extraordinary number. To put things into perspective, China alone accounted for more than half of global steel production in 2025. Now, why does this matter? Because iron ore and steel production directly determine iron ore demand. But there's one more small weird developing right now. Chinese steel exports have risen sharply in the past few years, and this is because Chinese steel has remained relatively cheap in global markets. However, this has also triggered increasing trade barriers in terms of tariffs, quotas, and also protectionism measures globally. Several countries like South Korea, Taiwan have introduced tariffs, duties against Chinese steel imports. China itself has also introduced a new export licensing framework, which is aimed at increasing this oversight on Chinese exports. So, if exports do begin slowing, then domestic steel production becomes even more important and crucial as the key driver of iron ore demand.
Thank you, Umang. On the chart on the left, we can see that exports are actually rising despite falling production. What is behind these seemingly divergent trends?
You're absolutely right to point that out. The last year was peculiar because the production was below 1 billion tons for the very first time. Now, the decline in production can be attributed to two primary factors. Number one, steel quotas in China. Number two, declining industrial demand from the property sector, the real estate sector, or construction activities in China itself. On the other hand, exports have been very strong, very robust because of availability of cheaper steel in global markets. So this is essentially what has created this diverging pattern.
Thank you.
Now moving ahead, let's discuss one of the most important indicators of in the iron ore market called port side inventories. Now, what do port side inventories mean? These are basically stockpiles sitting at Chinese ports awaiting consumption by domestic steel mills. Think of this almost like a warehouse inventory system. If inventories continue to rise, it means steel mills are consuming ore at a very slow pace. In other words, this also means demand is very weak. But if inventories are rising or falling, sorry, it usually signals stronger offtake by steel mills and therefore very strong demand. This is why inventory data has to be carefully watched. It helps us understand whether demand conditions inside China are strengthening or weakening in real time. You'll also notice that inventories tend to fluctuate around major holidays like Chinese New Year, which usually occurs in February, May Day holiday in May, and Golden Week in October because mills, what do they do is they often try to restock ahead of these periods. I've highlighted the pattern of postal inventories before the May Day holiday across the last 10 years, highlighted by the purple box that you can see. And here, the trend of inventories, you can see clearly that they have declined before the holiday has started. and this indicates that mills have had a good restocking pace right before the holiday. Okay, on this particular slide, we are trying to analyze the interplay and the relationship between the post-side inventory that we just discussed and iron ore prices. Let's first begin with the chart on the left. In the weeks leading up to the May Day holiday, inventories are declining steadily. What does this tell us? That steel mills are actively restocking iron ore at their own mills ahead of the holiday period. The stronger demand has helped support iron ore prices, because of which you can see the orange uh, line has increased before the holiday period, and the blue line, which is inventories, they have declined before the holiday period. Now, what's interesting is what happened after the holiday. Once mills resumed operations at the previous normal levels, inventories continued going down and prices also started rising. So, fundamentals remained very supportive even after the holiday. Now, let's compare this scenario with the chart on the right, which captures a very different dynamic that played out during 2024. Before the holiday, like you can see, the inventories were actually rising, demonstrated by the blue line, which means that there were weaker demand conditions in China. Yet, you also see the orange line is also increasing. Prices initially rose. Why did that happen? Most likely because the market were anticipating a post holiday recovery in steel activity. But eventually, fundamentals did reassert themselves. After the holiday, you could see the blue line or the inventories continue to rise, and this indicated weaker demand even after the holiday. And this indicated that mills were not consuming enough iron ore. And once the market recognized this pattern and realized that the demand was weak, prices corrected lower. This is a very important lesson in iron ore. Markets can sometimes move ahead of fundamentals based on expectations, but eventually the physical demand and realities tend to matter. Now let's move ahead from physical fundamentals to financial positioning. Singapore Exchange publishes a weekly report called the Aggregate Exposure Report. This report gives us insight into how multiple institutional participants are positioned in the iron ore market. One category that we track very closely on a day-to-day basis is the positioning of managed money participants. Now, who are these people? In simple terms, these are professional investors who are managing capital on behalf of institutions or investment vehicles. They include hedge funds, asset managers, proprietary funds, pension funds, and family offices. Now, why is this positioning very useful? Because positioning often moves alongside price momentum. Typically, you can see on your screen whenever iron prices start rising, management participants start building their net long exposure, represented by those bars on the graph. In other words, they become more bullish. And when prices start weakening, they usually begin cutting down their long exposure and start building short exposure. So positioning data can give us insight into how the market sentiment really is.
Thanks, Amang. As you said, AER report is so useful for traders, right? It's released every Wednesday. When you see that new data come out, how can you read managed money positioning as a signal?
Okay, so in the AI report, I particularly look for two scenarios. Number one, have management participants increase their net long exposure as compared to the previous week. If that takes place, it indicates the bullish conviction is intact and the management participants are very bullish on iron ore. The second scenario that can play out is that the net long exposure has been cut down or short exposure has been increasing. This basically supports the thesis that bullish conviction is declining and market participants are primarily positioning themselves for the downside in prices. Up until now, we have mainly discussed how fundamental theses are played in iron ore markets. But markets are not only impacted by fundamental factors, they are also heavily influenced by technical behavior. And technical indicators help us identify momentum, trend strength, and potential turning points. So on this slide, we try to narrow down a few technical indicators that can help you understand or read the markets a little better. Let's begin with moving averages. So moving averages help smooth out short-term price fluctuations and give us a clear picture of a broader trend direction. When a shorter-term moving average crosses above the 9-day or the longer-term moving average, for example, in this chart, the shorter term is the orange line, the 9-day MA, and the longer term is the 21-day MA represented by the green line. And when the 9-day MA moves above the 21-day MA, it is generally viewed as a bullish signal because it suggests momentum is strengthening. And that's what we actually observed in the month of April towards late April, where a bullish crossover emerged as iron ore prices started gaining upward traction. Next, we have the MACD indicator, moving average convergence divergence. This tracks the relationship between two moving averages and is commonly used to identify changes in momentum and potential reversals in the trend. We often look at these crossovers and divergence within MACD to gauge where the momentum is strengthening or weakening. Next is the RSI or Relative Strength Index. RSI is a momentum indicator that helps us assess whether the market is overbought or oversold. A very high RSI reading can sometimes indicate prices have overextended or rallied too aggressively in the near term, while a very low reading can suggest excessive pessimism. The next indicator on this chart is ATR or average true range. ATR primarily measures volatility. It does not tell us in which direction prices can move, but it tells us how aggressively prices are moving. A rising ATR means volatility is increasing and price swings are becoming increasingly larger, while a falling ATR suggests calmer market conditions. And last but not the least, we have pivot points. Pivot points are widely used to identify supports and resistance levels across different time frames. These levels help traders and investors estimate where prices can face buying support or selling pressure during, let's say, the time frame of a week, a day, a month, or a quarter. So collectively, all these indicators help us build a comprehensive framework around momentum, volatility, and key price zones. One of the fascinating aspects of commodity markets like agriculture, soybean, is seasonality. Certain demand and supply patterns do tend to repeat themselves in such periods like a year. Can we observe the similar patterns in El Nino is what we will be discussing next. Historically, like you can see the chart on the top, March has been a softer month for El Nino prices, and prices did decline towards the beginning of March and mid March. But this year was primarily different. Instead of declining, prices rallied very sharply at the beginning of March and continue to sustain that upward momentum. A major reason behind this, like you all are aware of, was the Middle East conflict, which pushed freight costs significantly higher. Higher freight costs effectively tightened delivered supply and supported prices. But if we zoom out and look at the broader seasonality, prices often tend to, let's say, soften in the months ahead. Now, why does this happen? Because in the second quarter of the year, April to June, Chinese steel mills typically plan more maintenances at their mills, due to which the production of steel is typically lower. And lower steel production means lower demand for iron ore. Lower demand essentially translates into lower prices. Now, the second pattern that we have observed is towards the second half of October, prices continue to rise. And why does this happen? We do see demand conditions improving. After the Golden Week holiday, which typically takes place from 7th to 14th of October, Chinese steel mills restart their activity, construction activity resumes, and many producers and Chinese steel mills They begin pushing for meeting year-end demands and production targets. Now, let's look at the heat map below. This compares the monthly iron ore returns over the past 10 years. One month which clearly stands out is December. December shows consistently positive returns, relatively low volatility, and a very high possibility of positive outcomes at around 91%. This makes December one of the most statistically favorable months if you look at historically for iron ore. Now, till now, we have spent most of this session understanding how demand and supply factors play into iron ore, how the market behaves, and position data along with seasonality. Now, the natural question becomes how can we actually convert all of these observations into actionable trade setups? This is what this next section will be about. We will be walking through a few simple backtested strategies built around some of the concepts that we just discussed. And I want to stress on the word simple here. The objective is not to build a perfect algorithmic trading session or section system. The objective is to show how market observations can gradually be converted into trade setups and rule-based frameworks in this market. Now, before discussing the results, there's a very important disclaimer that I would like to point out. These are historical backtests and conducted purely for education purposes. These are not in any way trading recommendations or investment advice. And always remember, just because one strategy has worked previously in the past does not mean it will continue to do so in the future. Markets are evolving continuously, and risk management is very crucial. The first strategy here is very simple and very straightforward. The setup looks something like this. Whenever we observe a bullish moving average crossover, we enter a long position the very next day. What is a bullish MA crossover? When the shorter term MA crosses above the longer term MA. The example that we discussed in the technical side was the 9-day MA moving above the 21-day MA. This is primarily a bullish MA crossover, and whenever such a crossover was observed in the last 1 year, we have entered a long futures position the following trading day. Now, this position is held for, like, let's say, 1 week before exiting. This is a very rudimentary momentum following framework. The purpose here is not to create a perfect system, but to demonstrate how technical indicators can be translated into trading frameworks. Over the past 1 year, like I just said, there were 10 instances of bullish MA crossovers. Out of these 10 trades, 7 of them were profitable. Therefore, this strategy had a winning rate of 70%. Now, this strategy, like I just said, was very rudimentary. It also comes with its own set of limitations. One major challenge with MA and the system is false signals. Markets don't trend all the time. Sometimes prices become choppy or range bound, which can generate repeated crossovers without sustained follow through. And that is why technical indicators alone are not enough. Now, the next strategy is linked directly to the inventory angle that we discussed a few slides previously. Historically, we have seen Chinese steel mills, they begin restocking iron ore roughly 2 or 3 weeks before the May Day holiday. Now, why does this happen? Because mills want to secure enough raw material at their mills before logistical activity slows during the holiday period. As a result, we do see inventories being drawn down ahead of the holiday while demand temporarily strengthens. So this strategy tries to capture that particular behavior. The framework again here is very simple. We initiate a long futures position roughly 3 weeks before the May Day holiday and then exit once the holiday period begins. We have analyzed this pattern across the years 2023 to 2026, and historically, out of the 4 trades, 3 of them were successful with a relatively higher winning rate of 75% higher as compared to the previous one. Now, this trade is not purely based on technicals like the previous strategy. Here, behavioral and operational flows do come into the picture and translate into price action. Again, the broader lesson here is understanding how physical market behavior can help us identify these repeatable seasonal opportunities.
Thanks, Amang. One question I have is, under what conditions can restocking before the holiday actually remain weak?
That's actually a very interesting question. There are primarily three factors that could cause restocking to remain weak. Number one, weakening steel margins or profitability being negative. Number two, all these Chinese steel mills having already elevated inventories at their mills. Number three would be higher iron ore prices, which can discourage steel mills to purchase or draw down more inventories from the ports and delay purchasing when prices stabilize.
Right. So when you see these kind of confluencing patterns, you probably want to avoid a strategy like this, right?
Absolutely. You do need to combine the strategy with some other market metrics then. Okay, the final strategy brings us back to slide 20. As we saw on that heat map, December has historically been a standard month for all iron ore futures. The returns have been strong, volatility has been relatively lower, and the percentage of positive monthly outcomes was exceptionally high. The strategy simply tries to capture this. Here, what we do is we establish a long futures position on the very first day of December and close it on the last day of December. What's notable here is that the strategy also has a relatively higher winning rate of around 75%, but with stronger overall and average returns as compared to the May Day holiday strategy that we discussed in the previous slide. But once again, and this is very important, that these are back-tested educational examples only. Past performance is in no way indicative of future returns. Please always conduct your own due diligence.
Aman, one question I had is for the strategies that you've highlighted over the last few slides, the prices that you're referencing here, are these front month prices or because futures, as you know, they have multiple expiries, right? Which expiries are you referencing here?
You are right, futures do have multiple expiries. So these are priced for the second front month contract. These are the benchmark contracts and these are more actively traded. So that is why I've chosen the second front month futures prices for reference here and throughout this presentation. Okay, now the next section of this presentation will deal with where do we commonly go for information pertaining to animal. What you see on your screen right now are a few resources and data sources that we regularly track on a regular basis to gather information about iron ore. A small disclaimer here is that in no way we are affiliated with any of these participants. The first one is Singapore Exchange. Here we therefore price and volatility data option chart book on a month-on-month basis. And here we also publish reports pertaining to options activity in the iron ore market. Number two, Smart Karma. Here we do refer for technical reports and technical analysis. Again, we do publish these reports on a week-on-week basis. Number three, Shanghai Metals Market. Here we get information pertaining to fundamental data, market dynamics, etc. Fourth one is My Steel, again very similar to Shanghai Metals Market. And last but not the least would be earnings releases by major iron ore players like Rio Tinto, BHP, Vale, or Fortescue. And these reports do contain a commentary about the market outlook, the industry outlook, and the geographic outlook, which helps us have more planned and more thoughtful narrative around iron ore in the market. We have also attached a QR code that links you directly to the XGX website where we publish our monthly reports on a regular basis. So if anybody is looking out to explore these reports further, please do feel free to scan the code and check this out.
Among one question I have, clearly there's a lot of sources to go for information in this asset class. What is the one place that you kind of religiously visit?
I think apart from the fundamentals that we just discussed, I would say options activity is very, very crucial. If we do see a build up in call positioning, that indicates bullish momentum is intact, and if we do see put puts building up, that means bearish connections slowly creeping into the market, right? So option positioning is very crucial to gain more knowledge on this market and to gauge it a little better. We do publish reports on a monthly basis, the monthly chart books on on the Exist website and also on Smart Karma. A QR code has also been attached here for participants if they would like to refer to it. Okay, so this brings to the end of this today's session. As we wrap up today's session, I want to leave everyone with a few broad takeaways that really sit at the core of INO market functions. The first takeaway is that INO today has evolved well beyond just the physical market. Institutional positioning through XGX futures and options have increased significantly over the last few years. We now see increasing participation from hedge funds, proprietary trading funds, family offices, and asset managers in the market. This financialization has strengthened INO's role as a global commodity benchmark. The second one is INO is deeply tied to China and global industrial activity and Chinese steel production. And because China dominates global steelmaking, any sort of shifts in Chinese policy, infra spending, or mill profitability can quickly influence iron prices. The third takeaway is that physical market indicators do matter enormously. Things like posted inventories, mill restocking activity, and export trends, they do provide us ideas and signals about underlying demand conditions. And we do have to monitor this on a regular basis. And last, finally, seasonality plays a very important role in iron ore markets, especially like we saw in the month of December. Historically, December has stood out with strong returns, lower volatility, and a very high percentage of positive outcomes. This usually coincides with mills ramping up activity and pushing to meet year end production targets. Of course, seasonality is never a given, it's never guaranteed, but it does help us to identify periods where market behavior has historically been a little more supportive. With that, thank you everyone for your time and attention today. Hopefully, today's session has helped you simplify how the INO market functions and how traders do position on approach this market from both a fundamental and a technical perspective. I now open the floor for any questions.
All right, thank you, Umang and Pranay, for such a insightful sharing session. Right, so if you guys have any question, right, you guys can click the question box on the top right, on the top right, and write your question there. All right, I think we can give them time to think of a question while I continue a bit on. Yeah, let me share my screen first. Okay, so guys, if you guys have any question, please feel free to ask now. So I will just do a bit uh close here lah. Okay, so for this is the online account opening. If you guys want to open an account, just can take a picture. Okay, this is where you want to contact us. Right, you can follow our Instagram or our website. This is also our Telegram channel if you guys want to join. You guys can take a picture first. Okay, so I think we got a question, right? All right, so uh I think Omang, we got a question. You guys can see, right, the question box.
It's not visible to me. Can you see the question box?
Yes, yes. So Han is asking, besides futures, is there any ETF that you can invest in when we want to invest in iron ore?
Right. So there are no broader based ETFs. There's one actually called the SLX, which is the VanEck Trade ETF. This ETF basically comprises of the top diversified miners which have a larger proportion of iron ore in their operations, comprised of BHP, Rio Tinto, Vale, Fortescue. So SLX would be the ETF that I would look into in that case.
Right. Just to be clear, there's the SLX ETF doesn't actually track the spot price of iron ore. It can give you indirect exposure through the largest miners of iron ore. Since the largest miners' revenues are impacted by iron ore prices, you'll generally see a pretty positive correlation between SLX and iron ore.
Okay, all right, guys. Any more question for our speaker for tonight? I think if no question, but if you guys have question, you guys can reach out to us, and we can also pass it to Umang and Pranay if they got any other question, right? Okay, so
Sure.
if okay,
Uh,
Right.
I got one more question. Yeah, okay, one more question, guys.
Sorry,
Um,
I'll just read out the question. So Robin is asking, how is the SGX for iron ore liquidity? Perhaps it might even help if I just go back a few slides. Where we talked about this. This one, yeah. Aman, you want to take this?
Uh, Pranay, are you sharing a screen?
Ah, it didn't get. I see. One sec. Should be visible again now. Yeah.
Yeah, so in terms of liquidity, the iron ore futures and options are both very liquid. And we, like you can see on the slide, there is an increasing participation on both uh, global funds from different kinds of participants like management primarily and financial institutions over the past 10 years, 15 years actually. And we do see increasing participation from Europe and US participants. So the futures and options listed on exchanges are very liquid.
And clearly, it's been growing, right? It's been growing at a rapid pace, and no sign of slowdown. Umang, I did have one more question for you. So, is iron ore linked to the AI rally? Is there any connection? Because I know that's on everyone's mind these days, right? You see what's going on with the tech stocks, the semiconductors. Does iron ore play any role into this?
To answer your question, I think not a very direct exposure to the AI rally, which is ongoing right now. It can happen through the construction route and maybe increasing um, data centers could increase demand, but this would be for base metals like copper, not much for iron ore.
Right. And I think you even had a slide about this, right? Uh, right here. Oh no, sorry, it's the first slide. Sorry about that. Yeah. So, construction is clearly written here, right? I think that's where I was kind of coming from. How big a role does construction play into steel demand as a whole?
And I think that's a very bad question. So, talking about construction, it consumes almost 40 to 60% of global iron ore and steel usage. So, it has a very heavy percentage of global steel making demand.
Right. So, given the kind of infrastructure build out that we're seeing, the large data centers that are being built out, and of course, the supporting energy infrastructure, There may be a push from that end that is worth looking at. But clearly, as you said, nothing on the spot market. It's more so for the long term. And especially what you want to watch for is supply crunches. During supply crunches, this increased baseline demand can be a perfect recipe for prices to rise. Okay, I don't see any other questions. If there are, feel free to reach out to us as well. Happy to answer them later on.
I guess if you guys have any other question that maybe you guys don't know how to put it right, you guys can contact us and we will gladly pass the question to Prani and Umang.
Right. Yes, absolutely.
Okay, so I guess no more question. All right, so I think that's all for tonight. So once again, I want to give my 1,000 thanks to Mr. Umang and Mr. Prane for taking your time to share your knowledge. I say we'll share to share your knowledge with us, and I also want to thanks the participant for spending your evening with us. I hope you guys can at least get something new from the webinar tonight. So like I said before, you guys have any question, please feel free to contact us. We will gladly pass the question to Mr. Omar and Mr. Prane. So once again, if there's no more question, I think we can engine our webinar for tonight. Once again, thank you so much for joining our webinar, and thank you, Mr. Omar and Mr. Prane, for sharing your knowledge with us tonight. Thank you.
Thank you
Thanks,
for having
everyone.
us.
Thanks to Phillips as well.
Thank you.
Bye.
Bye bye.